conference over to Mr. Pinku Pavan, Head of Investor Relations. Thank you, and over to you, sir.
Hello, everyone, and welcome to the fourth quarter and full year FY21 earnings call of LTTS. I am Pinku, heading Investor Relations. To those of you who have joined from India, thank you for participating at this late hour. We apologize for having to hold the call at this time. Our financial results, investor release, and press releases have been filed on the stock exchange and are also available on our website, www.ltts.com. I hope you have had a chance to go through them. This call will run for 60 minutes. We will try to wrap the management remarks in 20 minutes and then open up for Q&A. The audio of this call will be available for replay on our website approximately 1 hour after the call ends. Let me introduce the leadership team present on this call. We have Amit Chadha, CEO, Abhishek, COO, and Rajiv Gupta, CFO. We will begin with Amit providing an overview of the company performance and outlook, followed by Rajiv, who will walk you through the financial performance. Let me now turn the call over to Amit.
Perfect. Pinku, you can hear me fine?
Yes.
Perfect. So thank you, Pinku, and thank you all for joining us on the call today. I wish you and your families well and hope all of you, especially in India, are safe and healthy. Firstly, I would like to thank all our employees who in a difficult year have risen to the occasion, taking care of themselves, their peers, their families, and still being resilient in meeting the demands of our customers and keeping the customer satisfaction high. The safety and health of our employees remains on the top of our minds today. We recently rolled out a few additional measures towards the health and wellness of our employees and their family members, and we are working on a vaccination drive to cover all employees in India as quickly as possible. Moving on to our Q4 performance, I am happy to note that our revenues is back on positive year-on-year growth path. We achieved a sequential growth revenue of 3.9% Q-on-Q in Q4, and equally important, all 5 segments grew sequentially. Operationally, we had a good performance with EBIT margin at 16.6%, which, like our revenue, is better than pre-COVID Q4 FY20. We continue to generate good free cash flow, which has risen to a record high of 1,252 crores in FY21, led by good collections and operational improvement. Our large deal pipeline and conversions remains robust. In Q4, we have won 7 deals across all segments, out of which 2 deals are more than TCV 25 million and 4 deals are in the 10 to 15 million range. Now allow me to briefly touch upon FY21 performance. We had a tough Q1, but we pulled back starting Q2 and have delivered 3 consecutive quarters of both revenue and margin improvement. Our FY21 dollar revenue is down 6.3%, which is better than what we had initially forecasted. If you remember, in Q1, our guidance was for 21 was for a decline of 9 to 10%. The performance was aided by a gradual improvement of macroeconomic conditions in the developed economies and our focus towards pursuing and closing large deals and strategic partnerships. All along, we have also worked on improving and retooling our talent development programs that include innovation labs, which has helped us forge stronger ties with our customers. Let me now provide the segmental performance and outlook. Starting with transportation, we had a sequential growth of 6.5% led by auto and trucks and off-highway, while aero and defense had a marginal growth. We see traction in auto and trucks and off-highway, both in new areas like electric autonomous connected vehicles, but also in the traditional areas where spends are opening up. Customers continue to look at ways to optimize R&D costs and invest heavily in the transition to electric technology, autonomous driving, which involves much higher digital engineering. We are having conversations with OEMs beyond the product and into services like connected car platforms, AR/VR support. In aerospace, the defense side is doing well, while on the commercial side, the deal traction is slowly picking up as we diversify more into the digital side. The Skywise partnership is an example of the same that we recently announced. Overall, for transportation, our EV lab investments are paying off and we are currently pursuing multiple large deals in the areas of EV, autonomous mobility, and we are optimistic about the growth momentum continuing across all three sub-segments. In plant engineering, we had a strong quarter with 10% Q-on-Q growth. All three segments grew, while oil and gas grew strongly, aided by the early ramp-up of the large $100 million deal. Both in oil and gas and chemicals, we continue to see deals in the sustenance engineering space around plant digitization, engineering value center setup, etc. Meanwhile, capex spends in oil and gas are slowly opening up with oil prices steady. In CPG, brownfield expansion, sustainability-led projects like wastewater management, energy conservation are all growth areas for us. Coming up, for plant engineering, we see large deal opportunities across regions and expect the growth to continue into FY22, although Q1 may be a bit muted as a good part of the ramp-up of the large $100 million deal happened in Q4 itself, and there will stabilize for a small bit. At industrial products, we had a steady quarter with 1.5% Q-on-Q growth, with all three subsegments showing growth, electrical, machinery, and building automation. Demand is strong both in digital and traditional areas of product development and cost optimization. Recently, we invested in a sensor lab for rapid design and prototyping of domain-specific sensors, which will help us in differentiating our offerings further. Customer spends in this segment are likely to rise with the pickup of manufacturing activity in US and Germany. Investment areas range from Industry 4.0 initiatives like smart and connected plants, digital twin, sustainability projects centered around energy consumption and optimization of energy storage using hybridization. We see momentum in industrial products strengthening from Q1 onwards. In telecom and high-tech, we had a flat quarter as decision-making for some large deals remained a bit sluggish, even as we continue to win smaller deals. In semi, there is good momentum in chip design and testing in media for platform modernization and sustenance, and in telecom for network monitoring and 5G experience and labs as a service. Overall, customer discussions and deal pipeline is moving positively, and we are working on closing deals quickly. Lastly, in medical, we had nearly 1% Q-on-Q growth, a bit softer than we expected as COVID slowed the decision-making, especially in the diagnostic device side. OEMs are investing in digital platforms, robotic surgical equipment, and connected care, where we won deals recently. Cost optimization in Quora using new age technologies like AI, ML, and other areas are of traction. We expect growth traction to see a jump from Q2 onwards as the large deal traction improves. Shifting gears, as an engineering and technology company, it is important for us to continue to focus on digital engineering and technology investments. A few highlights. I'm happy to share that our digital engineering revenues are 52% in Q4 versus 49% in Q3. We see this trend continuing. On the innovation front, despite limited access to labs, our engineers continue to innovate and filed 148 patents in FY21. In Q4, our CHEST RAI and IBIM solutions were both recognized with the 2021 Big Innovation Award in the US. Lastly, TechGM, which is our initiative to connect with universities, had its 4th edition recently, where a record 350 plus universities participated. Let us now discuss the outlook. From a geography standpoint, we see a strong demand outlook in the US, while in Europe, customer discussions are progressing well, and we are seeing strength in pockets. In Japan and in India, the decision-making is a bit slow given recent uptick in infections. The deal pipeline is strong across all industry segments as customers are turning more optimistic about investing in new technology, which gives us confidence of broad-based growth. Our guidance for FY22 in dollar terms is 13 to 15%. I must add, however, that the COVID-related uncertainties are not fully behind us. As you are aware, the infection count in India has gone up significantly since April. So the impact on the delivery side is something we have to be watchful of. We have taken several measures to help our employees and their family members who are impacted by the pandemic, and we are hopeful that the situation will improve in a month. Let me end by wishing all of you good health. Thank you, and I now hand over to Rajiv.
Thank you, Amit. Good evening to all of you. I wish and pray that all of you and your families are keeping safe and healthy during these challenging times. Let me walk you through our Q4 and full year financial, starting with the P&L. Our revenue for the quarter was 1,441 crores, a growth of 2.8% on Q-on-Q basis. As mentioned by Amit, this was the third quarter of revenue and margin improvement since the pandemic hit quarter. And we are now back to pre-COVID levels, both on revenue and margin. The EBIT margin increased by 140 basis points Q-on-Q to 16.6%. The improvement was driven by a combination of better utilization, higher offshore revenue mix, and improvement in operational efficiency, partly offset by rupee appreciation against the dollar. We also had a 70 basis points benefit from lower amortization in Q4 compared to Q3. Q3 had higher intangibles related amortization due to Orchestra acquisition. Moving to below EBIT, other income was lower on a Q-on-Q basis due to lower export incentive income. We did not accrue any export incentive income in Q4 as the Government of India has yet to process the claims for fiscal year FY20. We are following up with the authorities to expedite claims for FY20 and also to provide clarity on the export incentive scheme going forward. Net income for the quarter stood at 195 crores, which is 13.5% of revenue, up 4.5% on sequential basis, driven by higher revenue and operating margin. On an annual basis, our revenue for FY21 was 5,450 crores, a decline of 3% largely because of the pandemic which hit us in Q1. EBIT margin for FY21 at 14.5%, down 200 basis points, again because of the pandemic impact in Q1, post which we have now recovered. Net income for FY21 at 663 crores, down 19% because of lower operating margin and other income. However, Q4 net profit level has come very close to the pre-COVID levels of 200 crores. Moving to the balance sheet, let me highlight the key line items. DSO was 75 days at the end of Q4 compared to 73 days in Q3, while unbilled days remained flat, Q-on-Q at 17 days. So combined DSO including unbilled stood at 92 days, which is within our target range of less than 95 days. The sustained efficiency in collections and improvement in operating margins has resulted in our cash and investments rising to 1,700 crores plus by end of Q4 FY21 compared to around 1,500 crores end of Q3 FY21 and far better compared to around 900 crores end of Q4 FY20. Let me talk about cash flows. In FY21, we generated a record free cash flow of 1,252 crores, which is nearly double of our net income. Like I have mentioned in the previous quarter, this performance was driven by the significant improvement in DSO in the first half of the year to sub 95 days, which we were able to maintain in Q3 and Q4. So you can expect the free cash flow conversion rate to see some moderation going forward as the DSO steadies at current levels. Moving to revenue metrics, the dollar revenue growth was 3.9% in Q4, with all 5 segments growing sequentially as highlighted by Amit. Growth was mainly led by transportation and plant engineering. The segmental margin performance was steady on a Q-on-Q basis, with transportation and medical improving marginally, while plant engineering marginally declining. Now let me comment on operational metrics. Utilization improved by 140 basis points Q-on-Q to 78.9%, while on-site offshore mix improved in favor of offshore by around 80 bps, Q-on-Q to 57.9%. The T&M revenue mix improved to 64% in Q4, owing to some of the recent deal wins. This has been between the 60 to 65 range in the past few quarters. In terms of client profile, which is the number of million plus accounts across categories, showed a sequential improvement in the 1 million and 10 million plus categories, while others were either marginally down or flat. Again, as I had mentioned in the previous quarters, this metric is measured on a last 12-month basis and not on a quarterly analyzed basis. Hence, we will see a better reflection of this quarterly picture in Q1 FY22 as we would move past the Q1 FY21 quarter, wherein the revenue dip was quite sharp. As regards client contribution to revenue, here again, this is on a last 12-month basis. Hence, it appears that top accounts have declined on a Q-on-Q basis. However, we've seen growth across top 5, top 10, and top 20 accounts on a Q-on-Q basis, in line with the overall company growth of 3.9%. Increase in headcount by 383 on a Q-on-Q basis, while attrition moved up marginally to 12.2%, well below industry levels. Realized rupee for Q4 was around 73 to the US dollar, an appreciation of 1% versus Q3. Lastly, on capital return, the board today recommended a final dividend of 14.5 per share, taking the total FY21 dividend to rupees 22 per share. This translates to a dividend payout ratio of 35% for FY21. Our return on equity stands at 21% for FY21, lower than last year, mainly on account of the pandemic which hit us in Q1, leading to a drop in net profit to 663 crores in FY21 versus 818 crores in FY20. However, we've recovered well both on revenue and margin since the pandemic hit quarter to come back to pre-COVID levels. Before I end, let me give some color on the EBIT margin trajectory we see going forward. In Q1, we will have the headwinds of wage hikes as we roll out salary hikes to employees at mid to junior levels. This is likely to have an impact on operating margin. We will try to offset this impact through improvements in a combination of operational levers like utilization, offshore ratio, employee pyramid, and productivity. We are also working towards improving margins in segments like telecom and high-tech and transportation, while pushing for better growth in the high-margin segments like medical, industrial products, and plant engineering. Overall, while we do not provide a guidance on margin, we will continue to work towards sustaining the progress made so far and adding on efficiencies to strengthen the operating model. With that, thank you everyone. Moderator, we can now take questions.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sudheer Guntupalli from ICICI Securities. Please go ahead.
Yeah, good evening, gentlemen. Thanks for giving me this opportunity. Amit, my first question is that there's a lot of noise around chip shortage disrupting supply chains across industries, from high tech to auto. One of our top accounts is also a key player in this ecosystem. Even otherwise, across our different verticals, starting from telecom and high tech to auto, we may be working on several projects where chips might form key inputs. So, how do you think this disruption, if any, will shape up going forward?
Okay, so thank you so much. So number one, the chip shortage that you're hearing about is manufactured delivery of chipsets and not design of chipsets. Right, number one. Number two, in automotive, all the programs that you work on R&D is actually model years that are 2 years out. So they are not current model years that you're working on. So as far as we are concerned, we haven't seen any impact of the chip shortage on our business volumes, neither in auto nor in Semcon. We continue to see both the areas investing in our work product areas.
Sure, Amit. And the second question is in terms of guidance. Actually, given the very favorable base of FY21, where actually revenue has declined, ideally the growth expectations would have been higher. But your guidance of 13 to 15%. So is it building in some sort of conservatism given the ongoing situation in India, and possibly factoring in some of the issues like absenteeism, employee absenteeism, so on and so forth? Or, as mentioned in your initial remarks, this remains to be a risk on even that 13 to 15% number. Potential employee absenteeism and all remains a risk on that 13 to 15% number.
So where we are today is that look, let me paint two scenarios for you, right? Two sides that went into this decision of giving 13 to 15%. From a market standpoint, we do see the US coming back almost at pre-COVID levels from a decision-making standpoint, other than commercial aerospace. We do see Europe in most pockets, or a lot of pockets, to be strong in terms of decision-making. Japan decision-making has been a little slow, and India, of course, as we are aware. So that's number one. Number two, what's gone into our heads and minds in this is the pandemic is not over yet, right? And it continues to wage on in different shapes and forms and affecting lives and health of people. So we have taken both these and the health of our employees, etc. And we feel that we're fairly comfortable with 13 to 15%. Of course, we'll come back to you next quarter again in case there's a change. We'll let you know. Look, our aspiration is to be to provide sustainable, profitable growth, and we'll continue down that mantra. So we'll continue to visit that. Deal pipeline remains strong, right? It's just that the closures cannot be accurately predicted. Right? So some of that, like we saw in telecom and high tech last quarter. So some of that is also baked in, but we are very comfortable at this stage. But we will continue to update you. Rest assured, the management team is working very hard to make sure that we come back strong and sure.
Sure, Amit. Thanks. That's it from my side. All the rest for the future.
Thank you. The next question is from the line of Mukul Garg from Motilal Oswal. Please go ahead.
Yeah, thanks for taking my question. Amit, just following up from the previous question on the guidance. If you look at the 13 to 15% number, it basically implies between 2 to 3% QOQ run rate. Now, if we again look at the last 3 quarter performance, it has been significantly higher than that, despite us being in a COVID-induced lockdown plus all the uncertainty around that. So while that definitely should form one part of your analysis, what other areas are kind of leading to the quarterly slowdown over next 4 quarters versus last 3 quarters in your assessment? And is there some sort of conservatism you have baked in on the risk of a flare up of another large COVID-related lockdown at your client ends, or is that more of a industry visibility you have?
Okay. So Mukul, 2 parts here. Number one, we have been growing at that 4% clip, right? And we want to keep on doing that. No questions there, right? But having said that, I mean, if I would have talked to you at the end of Feb, I may have had a different discussion. I mean, you've seen the number of infections that have gone up in India in the last 3 weeks. It just zoomed up. And this is India. Now, there is, that's number one, right? Number two is that though vaccinations in the US have been fairly high, UK have been fairly high, there is still, the fear and the thing that COVID may resurface in one of these countries. Number three, decision making, like I told you, in the last 4 months has been fairly robust, really good for us. Knock on wood, right? Our total TCV closures that we've had in Q4 actually have been better than Q3 if I take out that 100 billion deal. And our pipeline is also very strong as compared to where we were last year same time. We are not seeing any client cancellations. In fact, if anything, there is empathy and sympathy. Plus, 100% of our workforce is work from home enabled, and approximately 200 people are still coming to office because of labs, etc. But everything else has been sorted out. So the only problem I see right now is this COVID, and that's why we are giving you the guidance that we're giving you at this stage. But rest assured, we'll continue to work to make sure that we come back to pre-COVID clips as we can.
Yeah, no, sure. I think that's quite fair. Amit, the second question was on on the large deal wins. We obviously had a very $100 million deal last quarter. But if you look at your top 10 clients, while there is a base effect, but looking at a slightly longer term time horizon from 2018 onwards, it has lost a reasonable share of overall company revenues, and that probably is also partially on account of lack of very large regular deal wins. Can you share some thoughts on how do you see pipeline in terms of large and small deals going forward? And is there a possibility of maybe $50 million, $100 million deals kind of coming in at a regular clip, given the demand out there, or will it still remain predominantly a smaller deal market?
Okay. So Mukul, I'll answer your two questions. Let me talk about deals, then I'll talk about account sizes. Okay. So from a deal standpoint, I would like to assure you that we are today looking at a lot more. If I was to look at our deals that we have been closing, I see a lot more 25 million deals, 25 million TCV deals closing, as opposed to what I would have seen 2 years ago. So let's take the 100 million deal out. Just talk about normal 25 to 40 to $50 million deals. So the closures that we've seen in the current year, or we have just gone by, have been higher as compared to past years. Our 10 million plus deals that we have closed in FY21 has been higher than what we have closed in past years. Right? So that's 1 and 2. If I look at my future pipeline today, the number of 10 million deals that I've got going on, or 25 million deals going on, 50 million deals going on, there is a fair degree of those deals that continues to happen. You will agree with me, however, that the bigger deals that you have, say a 50 million deal, 100 million deal, take some time. It doesn't close overnight. The closure cycles are longer, right? So we are seeing that. We are definitely seeing, we are monitoring very closely and tasks our teams on their KRAs on the size of the deal that they close. So it's not just closing deal, but the size of the deal and bulking up the conversation and signing bigger deals. So that will continue to happen. As we go forward, we'll be able to share more with you, but that's a continuous process. Now, let me share with you on account size. So on account size, if you look at it, Mukul, we used to have 4 accounts that were, we had 4 accounts that were more than $30 million some time ago, and then, of course, it dropped because of COVID. But I do see that our whole aspiration as a management team, as a operations team in the company, is to get accounts as big as possible and be able to aggregate that. The good news is that clients also are helping us in this area to be able to go forward. I'm hopeful when I come back in Q1, right, at the end of it, you will start seeing this client pyramid improving. And we are focused on this. There is account management effort. There is delivery-led growth that we have institutionalized inside the company. So all those put together, we think will be helpful for us as we move along.
That's really clear, and thanks a lot for the detailed explanation. Best of luck for FY22.
Thank you so much. Stay safe.
Thank you. The next question is from the line of Vibhor Singhal from PhillipCapital. Please go ahead.
Yeah, hi. Good evening, sir. Thanks for taking my question. Amit, my question was majorly on 2 fronts. One is on the medical devices segment. So this segment has actually grown quite smartly for us. In the last 2 years, we've increased our revenue share for this segment from around 6-7% to now 12-13%. But last 2-3 quarters, when we would have thought that because of the pandemic, and as other companies also are trying to make inroads into the segment, this segment would probably be able to compensate for, let's say, the lack of growth that we had in other verticals. So any specific thing that you can probably point out in this segment that why the growth has been kind of a soft in this quarter especially, and how do you see this segment going for us over the next, let's say, 3 to 4 quarters?
Sure. So, Vibhor, as we see the medical segment, we do see work happening in 4 clear areas or 5 clear areas R&D focus that is there in medical. One is telehealth and the expansion of that. Second is connected devices that are there. Third is cyber security. Fourth is patient experience, and the fifth is digital manufacturing or automation, whichever way you want to call it. There are 5 broad areas. Now, the sixth one is regulatory compliance certifications that are there, right? Now, we had a good run-up last year in medical devices. Last quarter, we've only grown 1%, right? We are expecting some more deal closures as we speak. The big deal that we won last quarter in medical has to still ramp up. So we were expecting ramp up that slowed down a little bit, but the oil and gas expanded faster. There's a give and take here, right? That did.
Yeah.
But having said that, we are seeing traction in this area. And quarter 2 onwards, you will see clear growth coming back in this segment. This remains as a very important and high visibility segment for us.
Right. And as a management, I'm sure you have those targets, and also any specific number that we're looking at, let's say this segment to probably grow maybe 15-20% of our revenue at some point of time. Is there something that we're looking in a broader kind of a number, or is it just we're taking one quarter at a time?
We of course have internal targets that we've given out to our teams. The teams have taken based on where they see their pipeline and where they see client traction, client confidence, where they see trends, all that, right? But there is a little bit that is left to what happens finally. So I don't want to comment on specific percentages by segment, but I can tell you with confidence that it is an important segment as we look at it going forward. Just keep in mind that November 2nd through Feb 4th, the caseload in the US infections was the highest. It was above 100,000, 3 months, right? So that delayed a little bit of decision making. And in that segment, because elective surgeries again came down, etc. But post Feb it coming down, stabilizing, March being much better. So we will have some closures, and that's why I'm saying I'm confident that quarter 2 onwards we should be seeing the growth back in this segment.
Sure, sir. So there's one more question from my side on the supply side. So are we seeing any pressure from the supply side in terms of talent availability and the kind of basically the talent that we want, a mismatch between what we are looking for and what we are getting? Is it also partly reflected in the higher attrition number that we have in this quarter? And if at all it's a concern, what are we doing about it?
Sure. So I'll address it 2 ways, and then I will, if I miss out something, I will request my colleague Abhi to add to it. So number one, from a talent standpoint, let's call it recruitment, let's call it retention, and then let's call it retention and then motivation, right? That's how we will do this. So if I look at the recruitment part, you've seen there's about a 400 odd headcount increase that's happened in the last quarter, and our utilization also is at record levels. Utilization will improve slightly. We may be able to take it to about 80%, but we are an engineering technology company. We don't want to push it beyond that, right? Because there has to be innovation that has to continue to happen. We have to continue to differentiate ourselves, continue to invest, etc. So I do believe a little bit of optimization there. But recruitment will continue. If I give you a number, right, we have taken in more than 300 freshers in the last quarter alone. Over the next year, I do expect more than 1,000 freshers to be added into the company. So that is from a recruitment standpoint. Now, we continue to be in the market to recruit talent. All the 5 centers are hiring. So Baroda, Chennai, Mysore, Bombay, Bangalore, we are hiring. And we are seeing a lot of people wanting to join us because we are an engineering and technology company. We're seeing a lot of excitement there. So yes, can we hire faster? Of course. But I think the pace that we are at right now, I'm kind of satisfied with it, and we are working on trying to improve that as well. So that's in India, US as well, right? From a recruitment standpoint. Now, and I will request Abhi to talk about the training that we are doing, because he's running that engine very efficiently and effectively with his leadership. Second one is on retention part. And that again, before we used to be at about, if you remember, 14-16%. We came down to about 10% last year. Quarter 4 for us has been 12%. We have given wage hike to our juniors effective and mid-grade effective April 1st. Seniors will be effective July 1st. So as you will agree with me that there is a seasonality to the attrition, so there may be a slight uptick, but we will still be within industry standards and below our all-time high. I'm confident of that, and we're all working towards it as a single team to do that, and that's the retention part of it. So I'm hopeful that we'll be within the parameters that we govern ourselves on. Abhi, would you like to take the question on training and supply a little bit and explain to Vibhor as well, please?
Sure. Thanks, Amit. Vibhor, one of the, I think, great things we had done last year when just before COVID started was setting up a academy, Global Engineering Academy as we call it, for cross-skilling, upskilling talent. In fact, our confidence on taking up roughly almost 400 fresh grads we're taking every quarter. We did that last quarter, we did that this quarter, and we'll continue to do that over the coming quarters as well. Plus the lateral talent joining the company and upskilling them has been possible because of the academy we have set up in place, which has more than 15 faculty members, including PhDs and senior educators. I think the other interesting part is whichever way you look at it, we anticipated, I shouldn't say anticipated, but we didn't want to be blinded this time around. So we set up the academy in a manner assuming some or other event like a pandemic might happen again. So most of our cross-skilling, upskilling trainings are actually set in a manner that can be done online and through e-training modules that we have created. Of course, a small part of which has to be done in class as well. But that has given us confidence about hiring and upskilling folks, which is going to be critical in our growth in the coming quarters.
Thank you. The next question is from the line of Pankaj Kapoor from CLSA. Please go ahead.
Yeah, hi. Thank you for the opportunity. Amit, my first question is, normally you see some kind of a business attrition due to project completion in a year. Do you think the impact this year might be lower? That is in FY22, it might be lower than the traditional levels because of the abnormal revenue curve that we have in FY21?
Pankaj, thank you for the question. At this stage where we are right now, business attrition, or you're saying projects completion, right? Because we're starting from a lower base. We think will be lower than previous years. Yeah.
And this would be normally around 10-12% of the revenues, if I recall right. Is that the right understanding?
We don't normally quantize it, Pankaj. Yeah, but it will be lower than previous years is what we are anticipating right now, because we've done our account planning, we've gone through with accounts and all that. And what we're seeing is largely ramp-up conversations. And I'm touching wood as I say it, staying all healthy, all safe. The biggest unknown is the COVID bit, but assuming that takes care of itself, we are discussing ramp-up conversations with most of the places where we are.
Thank you. The next question is from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity. Amit, just on your initial remarks, you said this $100 million deal is largely ramped up in the Q4. So does that mean that incremental growth from this deal in the 1Q is unlikely to be that big? And if that is true, then Q4 growth outside this deal looks slightly softer as a whole. And a related question, if 1Q for the coming financial year is likely to be soft, is it the guidance baked in a back-ended kind of a growth for FY22? That's question number one. Question number two is in terms of what the CFO has said. Are we looking to maintain the current margin of 16.6% in FY22 despite the wage hikes coming in 1Q and 2Q as a whole? Because even a LTM increase in attrition indicates quarterly annualized attrition could have increased sizably in this quarter, and we have not given any wage hike in FY21.
Okay. So let me take the different parts that you asked. So your first question was around the 100 million deal ramped up. So, what's going to happen, Sandeep, is that the deal is slated to ramp up in parts, right? So there's wave 1, wave 2, wave 3, and then stable, right? And that's broadly it. And then once it goes past wave 3, Then there is the digitization part that we have to start doing on the side, right, while these waves are happening, so that we can help transforming. That's how we won this deal, right? It's not just a cost play; it's also a play of digitization. So wave one ramp up that we were expecting to happen in April actually happened earlier than that. That's the point I was making there. And therefore, I mean, will we be able to bring wave two in as well? Don't know. I mean, that's something that we're working towards right now. And that's why we have not said, we haven't said soft, we've used the word muted in quarter one. And of course, there are different deals that we continue to have and do, etc. And as things improve, we will come back on quarter two and talk to you as well. So that's where we are on that 100 million deal on plant engineering. Now, if I was to address your EBIT part, wage hike part, I'm going to look to Rajiv to answer that. Rajiv?
Sure, Amit. So, Sandeep, I think your question was, would we be able to sustain 16.6% EBIT margin in FY22? The way I'd like to respond to this is, we still have levers, right? And if you look at utilization in Q4, it's at 78.9%. There's about 100 basis points headroom, and we'll continue to optimize there. In terms of segmental margins, again, headroom for improvement in transportation. We've seen some uptick in transportation margins compared to Q3, and that's going in the right direction. Telecom, there is still headroom, and that's an area that we will continue to work. It'll take us a few quarters to get there, but we are persisting to be able to deliver better margins on telecom and high-tech segment. Amit and Abhi both touched upon, adding freshers, and I think that's also an opportunity, because when you look at FY21 and if you step back Q1 and Q2, with revenues coming down, clearly we did not have the opportunity to optimize on the employee pyramid. Q4, we've started to add freshers, and that opportunity we're going to continue in all of FY22. So truly our employee pyramid and our ability to, bring in mid to junior level resources with the whole academy part that Abhi talked about gives us, that much more ability to further optimize on the pyramid, and thus the project margins. And there are other operation levers also. The good part also is that we've seen rupee depreciating compared to what we saw in Q3. I mean, at least beginning of April, we've seen rupee depreciate. That will also be sort of a tailwind that we will count on. So these are a few factors that will help us balance, to the point that you made around wage hike in Q1 and Q2.
Thank you. The next question is from the line of Vimal Gohil from Union AMC. Please go ahead.
Yes, sir. Thank you for the opportunity. I hope I'm audible. So firstly, just wanted a clarification on your client metrics. What I noticed is you had a $30 million client which cannot be seen in this quarter. Plus, there has also been a reduction in your $20 million client now. If you could just provide some clarity over there, is the deal size got smaller there, or what has happened? That's question number one. The second question is again on the overall growth prospects of the industry. I just wanted your perspective on the longer term growth prospects of this particular industry. While as an investor, my expectation has been that this industry has the potential to sort of outpace IT services industry by a long way, because we are at a very nascent stage of accepting outsourcing in ER&D services. So does this 13 to 15% growth reflect the true potential of the industry, or maybe you have probably the growth rate could pick up post 23, maybe 22 when the COVID related fears are over? Thanks.
Sure. So I'll answer the question. Your two different questions. On client matrix, we follow last 12 months. If you look at the IR that we have released, it says clearly last 12 months. So it takes into account the last 12 months. We had a very bad dip in quarter one of 12.5%, and therefore some of the clients went down. Plus, if you remember, we had two clients that one of them that walked away from a business they were in, and the second one that became a private equity owned, and therefore they reversed, showed the work, etc. So all that is taken into account in that quarter one. So as you start seeing, next quarter when we come back, so the quarter one will be over, right? The quarter one will no longer be considered. It will be Q2, Q3, Q4, and Q1 of FY22. You will see this matrix coming back up. Please rest assured the company is divided up, hunters and farmers in the company from a delivery standpoint, from a sales standpoint, and delivery-led growth with ADM, account delivery managers from a delivery standpoint, and solution architects from a CTO standpoint. So we have done all those three, and we are pushing all pedals to keep growing our accounts. So hopefully last 12 months averages will change, numbers will change, and the matrix will look better as we continue to talk to you in successive quarters. So that is as far as client matrix is concerned. And there is an ability in engineering for accounts to be 30 million plus, to be 50 million plus. I am confident of that. We have had a setback in quarter one of last year, and we are working through it, right? So that is one. Now let me go to growth. From an industry standpoint, and I'm going to quote some numbers that Zinnov published recently in March, okay? So for them, the ER&D industry in 2019 was $1.49 trillion. That number went down to $1.4 trillion because of the pandemic in 2020. So a 6% decline year on year. They are expecting that the engineering ER&D spend will jump to close to 2 trillion, so 1.8 to $2 trillion in the next 3 years. So are we saying that the growth is tapered out? Absolutely not. We absolutely share your enthusiasm, Vimal, for this industry. Just that COVID has been a setback. We do believe, knock on wood, it should be behind us, and infections in India should come down, and we should go back to. We aspire to be at levels where we used to be at, and the industry offers that opportunity. Now, if you ask me, kind of work, that digital engineering work is picking up, and that's where we are picking up as well. And there is legacy engineering work also coming in. So we are hopeful both of these will help as we go forward. But we share your enthusiasm of the industry.
And Amit, you're also hopeful of outpacing the industry, because obviously that's the whole mandate, right? You're hopeful of outpacing the 13% number.
So if I look at my competition right now, in terms of where who fell how much, and it's not a good way to do it, but who fell how much in the current fiscal year, our growth from an engineering standpoint has been we've not fallen as bad as peers. We recovered faster than peers because we have differentiated offerings. We've got 5 verticals. We've invested in labs. We've invested in patents. We've invested in our own platforms. So I do hope that we'll come back. Just give us some time as we go forward. We've always looked at all of you for support. You've been very supportive. We look forward to making sure that we come back and we continue to perform.
Great, Amit. Thanks. Great to hear that. Thank you so much, and all the best.
Yeah.
Thank you. The next question is from the line of Kunal Dayan from Bank of America. Please go ahead.
Yes, sure. Thanks. I have a couple of questions from my side. The first one is, regarding the autos vertical, you were mentioning that the demand is strong both in the traditional as well as the new areas. So I was wondering if you would view the growth prospects for the segment to overshoot the pre-COVID range over a period of time, or should we think about the segment sort of going back to the original trajectory or the pre-COVID trajectory? That's one. And then second, just a follow-up on the delivery risks you were talking about. So, I mean, the delivery risk part of it, is that just related to the health and the associated disruption, or should we also think of projects which are sensitive to, let's say, an office location probably slowing down because employees potentially can't get to office for a period of time? Thanks.
Sure. So I didn't get your name. Can you repeat your name for me, please?
Sure. This is Kunal Sayal from Bank of America.
Kunal. Okay, Kunal. Yeah, I got Bank of America. I didn't get Kunal. Okay. So Kunal, number one, Automotive, we definitely see growth happening in electric autonomous connected area, right? And this is a clear area. And let me take a minute on that and talk about it. See, when I talk about electric autonomous connected, it is not just that, you will get, so the kind of work that you will get, right, will be around the e-powertrain components and vehicle controls, which is software and hardware work, right? You will get work on onboard energy management, which again is hardware and software work. Offboard energy management, which again is hardware, software work. Then there's the EV chassis design, because the car itself is changing, right? And the loading factor, etc., is changing. So therefore, the loads are changing. So therefore, that will be the legacy work that will come in, right? And finally, connected and autonomous will also be a lot more software. So there is software, hardware, and mechanical, electrical work that will come in auto, and not just auto. I should also add that if I look at T&OH or trucks and off highway, they want connected vehicles. They would like to have kind of safe environment where they can see a surround view of an object, do analytics properly, so they don't at a construction site, the excavators, the boom, these boom cranes and all that don't hurt people, right? Because you don't want people to get hurt. So all that. So it's not just auto; it's T&OH and auto. And I'm hopeful at some point the commercial air will come back and we'll start talking about narrow body and start talking about alternative energy for aircraft in a bigger way. The design cycles are of course much longer, 10 years long. So I do expect that to happen. So I do expect, and the deals we've had, plus I talked to some of you earlier last quarter that we had made investments to start working with the new age auto companies as well, right? And that again is starting to see some color and fruit for us coming in from California. So I do hope that all that put together will help us in improving our in growth in automotive and T&OH, both of those, and defense also. We are getting contracts with our ITAR centers in the US, so that should help us as we go forward. So broad base, all the three subsegments should fire and grow for us as far as transportation is concerned. Now let me address your second question, which is delivery risks. So I'm going to say this, and I thank again everybody on our call, management team that's done this, and Abhi especially, along with our admin team, our HR team, etc. 100% of LTTS employees are enabled to work from home. But 98 to 98.5% of the people can work from home. There's about 1% population, 1 to 2% population that needs to come to work. So here's what we've done about it. We've actually created something called bio bubbles. So in Bangalore, in Mysore, in Bombay, we've taken these small apartments where we are sending in sanitation crews, cleaning crews, etc. There are people that stay there and they walk to work and go back. So we're trying to get around there. We've created home labs. So there are people that have bigger homes, etc. They've taken equipment home, they've set it up, we've kitted them with backup power, etc. So others can log into that and do it. Our IT teams and our admin teams, I would call them our warriors, because they continue to go to work to make sure that the rest of the company is functioning. So all that is there, but yes, our delivery risk is not from people not being able to work, but actually the health part where people fall sick and they cannot work, or a close relative is sick and they have to take care of him. I mean, these are times where, Kunal, the only word that I've been repeatedly using and our whole management team uses is empathy. I mean, empathy and prayers are what we need right now to go out, and that's what we are doing. But that's the risk that we see. It's not work from home enabled, etc. Because IT, etc. We have learned whatever we had to with the bio bubbles and labs, etc. that we've already done. So we have done that. Abhi, anything I've missed that you'd like to add to this?
No, I think you've covered it all, Amit. Thank you.
Okay. Thank you.
Thank you. The next question is from Dipesh Mehta from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity. Couple of questions. First is about, just want to get sense about the leadership change with Rejik after Pandaji retired. So if you can help us understand how the responsibility get realigned across different functions. Second question is about, do we see, let's say now as we recover from pandemic, any change in spending pattern across segments? any new kind of demand which you are witnessing and which is accelerating your growth trajectory or medium term? And last question is about the amortization charges. Now, Orchestra acquisition, I thought it would be steady kind of number. We have seen some volatility. If you can provide some more detail. Thanks.
Okay. So I'll take your spend leadership and spend pattern questions, and I will request Rajiv to take the Orchestra Technologies question. So from a leadership standpoint, this has been, as a lot of you are aware, I have worked for Dr. Panda for about 20 years now, 2 decades. And I'm thankful to the fact that he's trained me, coached me, mentored me through the journey. I've been in the company for about more than 11 years now. I've played different roles. I started off as the head of sales for North America, and then I picked on different responsibilities, including being the chief sales officer at one time, along with running delivery and operations for a part of the company, as well as I had the mandate to build up the digital offerings for the company prior to Abhi joining the company. So I've had experience through the functions. So I don't know what I don't know. That's the reality. But I think I've been trained well, kitted well. We crossed 1 month yesterday, and we're so far stable. Second, the other CXOs in the company, the Chief Operating Officer who's on the call, CFO who's on the call, our CTO who's also on the call, and CHRO have been in the company for some time, and we've been working as a true one management team to take things forward. There were some other changes that we had to make in the running of the company that we made while Dr. Panda was around. So we made sure that we are good and stable. Only time will tell, but I'm really excited at the opportunity that I've been provided by the board. And with the coaching and mentoring I've received, I look forward to taking this forward to greater heights with the employee base that we have today. And I'm thankful to them for having their trust and faith and support. From a sales standpoint, we have appointed last year, while we were going through the transition, we appointed a chief sales officer for Americas and Asia and a chief business officer for Europe, and they work directly with me, and the other chief business officers work with these guys, and so we are fairly stable from that standpoint as we see it today. In fact, some of the growth that we have had is because of the stability that we've been able to provide from that standpoint. Now, if I move on to spend patterns in the US in most of the segments are near pre-pandemic. It's not truly there, but it's near there. The optimism in the market is there. Every day, the moment infections keep going down, vaccination numbers keep going up, we see there's a lot of positiveness in the market. The Biden $2.1 trillion plan that he's talking about, plus another $2 trillion for families. Europe is talking about their own plan in the range of about 1.8 trillion euros. So all this is creating good sense in the US. Europe, however, if I may be very clear, we've seen where we operate, right? So Germany, UK, Sweden, Denmark is the areas we operate, and then France and Netherlands. We're seeing a lot of positivity in people's mood, but it's not as much as the US. We expect it to come back. Japan and India, of course, was actually full-blown recovery till 4 weeks ago, right? All engines fired, but more than business sentiment, I will say there's an emotional sentiment that is low. We as a management team are working very hard within our company to keep the morale of the company high, and I thank the employees to keep the morale high, right? But that's there. And Japan again has been a lot of kind of little soft because again they are not very used to making decisions on video. So that's the part that we have. But I overall see spend patterns to be improving from last year, and I'm confident of the future. Rajiv, would you please take the OT question?
Sure, Amit. So I think your question in terms of amortization in Q3 pertaining to OT, 2 parts to it. One, there are certain intangible assets that were more, near term that had to be written off in Q3. That was more one time. As far as the amortization, it continues even in Q4, and that will continue, of course, for a period of time. So that one-time amortization that we saw in Q3, that's the benefit you're seeing in Q4. And we already called out that's about 60 basis points of improvement that we see in Q4 compared to Q3.
Thank you. That was the last question. I would now like to hand the conference over to Mr. Pinku Papan for closing comments. Over to you, sir.
Thank you. Thank you for joining us on the call today. We hope we were able to answer most of your questions. If you have any follow-up queries, please reach out to me on email. Wishing you safe times. Goodbye and have a great day. Thank you.
Thank you. On behalf of L&T Technology Services, we conclude today's conference. Thank you all for joining. You may now disconnect your lines.